Hi all, so let's try to understand the price to earning ratio today and the three most important factors that tend to affect this price to earning ratio. So the price to earning ratio is one of the most important valuation metric which is being used to judge the valuation of your company. That is whether your target company is overvalued or undervalued as compared to the past averages of the price to earning ratio for that particular stock, or maybe the past averages 5 years, 10 years of that particular sector. So it's taking into consideration the price in the numerator, the current market price of the particular security in the numerator, and you have the earnings per share in the denominator. So the earnings per share is calculated as the profit after tax divided by the outstanding shares of the company, and you tend to take that component of EPS, that calculated component EPS, into the denominator of this ratio, right? So price to earning ratio. So price to earning ratio is being affected by three most important parameters. The first parameter is the interest rates. A higher interest rate in the economy has a negative relationship or inverse relationship with the price to earning ratio, usually, because whenever the interest rates is rising, the price to earning ratio may fall, and when the interest rates are falling, the price to earning ratio will rise. Now this is, I mean to say, the magnitude or from a quantum perspective. I'm not talking about the expectations, because currently we can see even the price to earning ratio of the companies are very high. The companies have become overvalued and the interest rates are also very high. Why? Because there is the expectation that the interest rates will fall down in near future, because the expectation also works, right? So that is one thing that we need to understand from an expectation point of view. If the expectation translates into higher weighted average cost of capital, higher discount rates for capital, and those future cash flows tend to get discounted at a higher rate. So that is one nuance of this inverse relationship between the price to earning ratio and the interest rates. The second factor which affects the price to earning ratio is the risk. When there is higher risk in the economy, again the price to earning ratio might fall. Why? Because again those cash flows of that company will be discounted by a higher discount rate, because that higher risk encapsulates or translates into the cost of capital through which these future cash flows are getting discounted. So again, this risk and price to earning ratio has an inverse relationship. The third parameter is growth. Whenever is a high growth company, whenever the growth is very high for that particular sector, or the company is achieving huge growth through various other parameters, to strategical objectives, to management commentary, and the actual growth can be seen through margins, through the points of capital structures or revenues, right? So again, the price to earning ratio will be high. Both growth and price to earning ratio are having a positive relationship, because ultimately that growth is being denoted or justified by the denominator of this ratio, right? Because EPS is the earnings growth of the company. If the EPS is rising, right? If the EPS is getting justified, right? If the company is having huge margins quarter by quarter, year by year, so that would be reflected in the EPS, right? And that is why we tend to say the earnings growth should be justified. If the company is having a higher price in the market, the earnings growth should be justified, and this earning growth is nothing but the EPS of the corporate or a particular security. So if the earnings growth is getting justified, again the price to earning ratio would be higher, right? And one last thing that we need to understand is the two components of this ratio, that is price in the numerator and EPS in the denominator. Price is always a leading indicator, because price is also affected by sentiment, or usually always affected by sentiment, right? Because you tend to hear some positive market news about that particular sector or particular company. You tend to hear some negative news about that particular sector or company. Again, that positive news can be an actual positive or a fake positive. Again, the negative news can be an actual news or a negative fake news. And this might temporarily or up till a certain amount of time affect the share price of the company. But EPS is something that you do not get to know on an everyday basis, because companies tend to declare their PAT, their outstanding shares, on quarterly basis or annual basis. So this EPS is a lagging indicator, because you need to wait for a quarter or a year, maybe a quarter, to get that number of EPS, to get that number of PAT and the current outstanding shares, to get that EPS component, right? And that is why EPS is a lagging indicator. So be very careful while using this price to earning metric. Thank you guys.